Hi, everyone. Welcome to this edition of Nebraska Farm Bureau's Inside Profitability. My name is Austin Harthorn. I'm the economist here at Nebraska Farm Bureau. We're very excited for what we've got for you here today. But first, we'll give you some background on what this is for some of the newcomers today. This edition of Inside Profitability is one in a series of videos published by Nebraska Farm Bureau. Once a month, we come here to discuss pressing topics on the minds of our members, specifically those that have a significant impact to their bottom line for our farmers and ranchers. We hope the series has and will continue to bring value to managing your operation. And if you have any topics you'd like us to cover, please email me. My email is austinh@nefb.org. But today, we're going to discuss a fast approaching deadline that needs to be, and likely is, on the top of a lot of your minds, the March 15th crop insurance deadline. I doubt I have to sell very many of you on the value of crop insurance, especially coming off a year where drought covered every corner of the state. Bottom line, crop insurance can be the difference between not only an average year and a bad year, it can also be the difference between whether your operation survives to see another year at all. So crop insurance is important. It's a huge part of any risk management strategy. But every farm operation and every producer on those operations are different. And with a lot of different coverage options, picking the right crop insurance approach can be a stressful decision, bottom line. While we'll leave most of the advising and actual decision-making to the conversation between you and your insurance agent, we can give you a deeper look at some of the programs to help guide you towards what's right for your specific operation. And to help us do that today, we've got Cory Walters from the University of Nebraska-Lincoln. Cory is an associate professor in the Department of Ag Economics, where his areas of expertise lie in the realm of green marketing and crop insurance. He also farms in western Montana on the side, in not corn and soybean country. He grows crops like wheat and canola. And along with this, he's also an all-around great human being. And I can say this because Cory happens to be my advisor from grad school, and he was right there with me as I struggled and clawed my way through my master's program. Anyways, welcome, Cory. Thanks for being here. I'll kind of let you take it away.
Awesome, Austin. Thank you very much. Thanks for having me. That was a great introduction, Austin. Thank you. The topic is well introduced. You already got to the March 15th, so we're going to be going right into that busier time where we're going to get these prices nailed down here next week, and then we get to decide what we're going to do before that deadline. So. And I'm going to give some insights into that and some places I think where there's some issues and how to better manage your crop insurance, how it embeds into your farm portfolio, your farm financial portfolio. So I titled this the 2023 crop insurance prices, rare events, and strategy. It's always something good to think back through what's driving these insurance premiums and how we can decipher the information that they're giving us. So let's start off with the basics, and there we go. Let's see where we're at right now. As of this morning, so we're recording this on Friday. We got 2 more days to get these projected prices, but I'll be pretty close here. Corn right now, the average price for the December contract during the month of February is at $5.95 with a volatility of 0.18 for 18%. Compare that to last year, we were at $5.90 and a volatility of 0.23. The big takeaway here, and this has been floating around through ag pretty well, is this volatility factor is coming down. So that's going to tighten these distributions, which I'm going to show you here in a few slides, and you'll pay less than for crop insurance this year with a tightening of this volatility factor. Over on the soybean side, we're seeing this something similar, 13.78 a bushel. And a volatility of 0.14, where last year we were in the 14s, and then a volatility of 0.19. So again, coming down on that, and you'll see a little reduction here. So we're setting the prices here for this upcoming year, and there's a lot of information that producers can use with this, and you can be highly strategic with that. But we also have to be cognizant that these markets are going to evolve. And we don't know how they're going to evolve. So let's talk about that a little bit. This is a graph of last year's December corn futures. So this would be down here on the number of marketing days is 0. This was right around March 1st. We're right around that $6 range. And for the next number of months going into the growing season. Prices came up, came down, and then came back up for harvest, and we ended up higher than we started, which, like you mentioned, Austin, we had some yield issues, and then with the revenue protection policy, we took out that lower projected price and put in that higher fall price or harvest price, and got us a few more dollars. What we want to be concerned with is the first thing is this upcoming year is not going to be last year. Okay, we cannot use last year as a benchmark. That's one observation of prices that can go in many different directions. Okay, they're going to evolve unique to each other. Here's a couple price series. We got 2008, and then the drought to 2012. We place a lot of weight on droughts occurring, especially coming off of last year, where we did have some rainfall down across the state. So in 2012, prices started off just kind of slowly going down, and then they took off due to the drought, and then something different happened in 2008. They came up and then came down. Okay, so here's two price series that look nothing like 2022. And let's go to the more exciting chart. So these are log returns, but essentially it's the same thing over many different years. I got all kinds of different years over here, and we have prices evolving in many different ways. And so the point here is twofold. One is no one's going to tell you how these prices are going to evolve this year, what information is going to hit the market price. We cannot see that. But what I can tell you is when we get to the fall, we get to harvest time, there's a wide range at which prices can end up. And this is the price risk that we're going to manage with crop insurance. And of course, you got other tools in there, hedging and stuff. We'll leave that for another time. But essentially, you want to stay out of things down here where prices end up, drastically lower than where they started. But there's a lot of range here. So that is your price risk. This is looking in the past. Okay, we have to look forward for this upcoming year. So let's get into that. This is the theoretical price distribution of where prices could end up this fall. And let me explain to you what this means. Once you see it, it's pretty straightforward. So we're starting off right now with a price around $5.95. That's this black bar. We have prices down here on the x-axis, and then on the y-axis we have probabilities. Okay, so we're modeling all those and have all outcomes in here because we have probability from 0 to 1. And this is by the way the same way that the RMA is going to do it, how they're going to price your policy. So if we go to a 595 and we want to find out what the probability of the price is ending above or below that, we go up to where we hit the red line, and then we move over on that, and I did that twice now, third time's a charm, and we move over to where we see that chance. So at the 595, there's something around like a 52% chance that prices will end up below that, and a 48% chance that prices will end up higher than that. That's fine. Let's go down here to some low prices. So we could reverse the order and come over here at let's say a 5% level. And you say, what's the chance? What price is there a 5% chance of prices ending up below that? So we go over here, hit the red line, go down, and that would be somewhere right around, I'd say probably 460-ish or something. So that's a 1 in 20 chance. We can go up here to the really high side. Anywhere you see a number or the red line, there's a chance. So you can ask yourself, well, what's the chance of prices going above $9 come this fall? Well, let's just put it right about there. We go over, well, there's a 1% chance that come fall prices could be over $9. So that kind of gives you your price distribution. This would be up here. This is on the drought side. Okay, and then down here, this is on a gigantic crop, losing demand, other things down here. We're talking about insurance here, and we're trying to stay away from events that that make the banker not be our friend anymore. So we're trying to stay away from events down here. And it's not the most exciting thought process to think about, rare, low probability events, but it's literally those events that place stress on the farm finances. And so we have to think about those. And this one here gives you probably your best unbiased eyes on what those chances can be. I'm not putting any of my beliefs in there. You have to put your beliefs in there. Some of us may think that there's, we're going to grow a big crop, and so they put a higher chance on prices down here. Some of us think it's going to be a drought, so they're putting a high across the corn belt. Of course, I'm going to put a higher chance of this happening up here, and that's fine. That's us as an individual. So what can crop insurance do in here then with this? Let's take a look at that. So all I did was I assumed an 80% coverage level. So I took 20% off, a 20% deductible, and I took 595 times 0.8, and that gets you at 446. And that's a price somewhere right in here. And you go over, and that's then about a 5% chance. That was similar to my example earlier. So again, about a 1 in 20, about a 1 in 20 chance. So that's actually fairly reasonable. We don't want that to happen. So what that means then in the world of crop insurance, that if you grow a big crop and the nation does, and prices go down, and you grow your APH bushels, your actual production history bushels, and price drops below 446, you'll start to receive an indemnity on that thing. So that's essentially what that gives you. Of course, in revenue protection, you got two things changing that you have to account for: yields and price. I'm just going to talk about the price side here today. Over on the soybean side, let's go through that. So I was over here at what was that price? 13.78 or something like that. And you go across, and again, that's right around maybe a touch over 50% here. This is the median, not the average here. That gives you an 1102 as a projected price down at an 80% coverage level. And you take that thing over, and it's looking like a 7-8% chance that thing could be happening. So definitely a positive chance and reasonable. And again, on soybeans, you got the drought side. You got that up here. Again, not too concerned about that at this time. Trying to manage the finances from events that put stress on us.
Hey, Cory.
Yes, Austin.
Before you move on, could you talk about where that price distribution, or I guess the probability distribution, comes from? Is that based on historical price volatility going back to a certain time, or?
Yeah, you bet. So
Okay,
it's actually both of them are right here. So we're treating that as a log normal price. And so all you need is a mean, which is the 595, and then the volatility factor or the standard deviation. So it's just these two things is all that creates it. And if we were to go back and put a volatility factor in that we saw last year in a 0.23, then what that would do to this thing right here is it would just blow it out. It would make these tails down here come over this way and just be fatter, and they come down. So it would put a higher chance at even lower prices. And then of course, a higher chance of even higher prices. So this year we're squeezing that volatility. We're putting the final price around a smaller area.
And that's price volatility throughout, I guess, the month of February for spring price, and throughout, well, is October for fall price?
For corn, it's the December contract.
Yes. Throughout the month of February, or throughout the life of it? Yes.
Throughout the month of February. Yes, that's
Gotcha.
right.
Okay.
That's right. Yep. So we're taking an average over this whole month. And so that's why we're going to come in pretty close to this 595, because we just have a couple days here. And then of course in the fall, we'll recalculate this thing, during the month of the December contract, or the average over the month of October.
Yep.
Yeah. So that's how simple it is. And that's why these volatility factors matter so much, is when they'll start getting higher, and it puts a higher chance of these events occurring when you drop down, this 20% deductible, then you're going to pay more for that. I'm hearing things like $4 or $5 per acre cheaper this year with the same coverage level from last year, just because of that price. Also in this is, let's stick down here a little bit. This is around a 5% chance. So the opposite of that is there's a 95% chance prices will end up above this thing. And I hear a lot of people complain a little bit about, well, I bought insurance and it didn't work. This line is a summation of possible outcomes. We only get one of these this year. We'll get one dot on here. And so there's a 95% chance you're not going to get any price payment out of crop insurance. That is a good thing. You want that. And we'd of course like it to be higher than where we're at right now. You don't want it to be, right here. But that is higher than dropping down into this area that it gets really bad, really fast. So there's a lot being discussed in here, and a lot of ways we have to process this information. So that pretty much wraps up the crop insurance price side. But I have a couple things on SCO, supplemental coverage option, and ECO to think about. Austin, you ready for me to go into this?
Yes, sir. Go ahead.
Okay. So supplemental coverage option and enhanced coverage option, these are two contracts also offered by the RMA. And let's give a good background of them here. I got this from American Farm Bureau Federation. It's a wonderful slide. Let me walk through this thing. So you have your normal farm level multi-peril policy. Oftentimes these are revenue protection policies. That's the dominant ones being sold here in Nebraska. And this is at a 75%. So you got a 75% coverage level. So if you buy, I'm just going to stick to the SCO side. So if you buy SCO with a 75% coverage level, you would then insure this area from 75 up to 86. And then you can go this ECO thing, which would go up a little more. And you got two of them there, a 90 and a 95. So on the 95, you go from 86 to 95. And on the 90, you go from 86 to 90. There's the devil's in the details in here. And I want to talk about what's all going on in here. And I'm getting a lot of pressure, or hearing a lot of stuff that there's pressure for people to be buying these things. And I don't want a bad outcome to happen that wasn't previously thought about when you buy this. And so let's talk about what the problem is. But let's first talk about what does it do for us today. So let's get into that. So if we buy this thing, it's off the same price, the $595, and we drop down to 86%. So it's a 14% deductible. Then we're down here at this $511 mark. So if prices drop below $511, you'll get a payment. And there's about a 21% chance come fall, when we get to the fall, that prices will be below $511, a 21% chance. So still 4 out of 5, will be above that. But it definitely gives you, there's a lot higher chance of that occurring. Of course, when that happens, you'll pay more for it. And that only protects you, down to that, from that 75 in that example up to, wherever you're at. So it's a gap inside here. Okay, so it definitely gives you some good price protection. It's not a bad tool. If you're thinking there's a reasonable chance of prices dropping between now and fall, that this SCO could be something good for you. But let's talk about the parameters inside SCO and your location. Okay. The big kicker with SCO and ECO is that yields come from your county. All right. And in that, that's just inherently different than your multi-peril that's coming from your farm. So you grow so many bushels on your farm, you drop below a certain threshold, you get a payment. On this one, you get a payment on how the county does, and the county may not be you. So you have to think slowly through this and consider the relation between your farm and your county. Okay, and understand what that means, what it may be exposing you to and not exposing you to. And so the way they do this is they detrend the data They take this trend out, we're growing more corn over time, and then project into the future. And so for 2023, the expected yield comes from 2021 data and past observed county yield data. So they're just taking a trend and extending it a couple more years, and that will give you your expected yield for the county. Two questions comes out of this. Does the county level yield reflect what experts in your county say? I strongly encourage you to go find out what your county level yield is and go ask other experts in the county. Does this represent us? Is that what it is? There's been some evidence I found that that's not entirely the case. That the county yield, according to on the SCO and ECO side, is actually lower than the trend. But I'm not entirely sure where they're getting the trends from. So when I do it, I'm getting a different number. But that's okay. It's okay to still buy it. We know let's suppose that's there. It'll cause a little headache, but if you're after the price side, it could still be very valuable. Between your farm and the county, you want to ask the second question. When there's a problem at your farm, does SCO or ECO trigger? So your farm gets hit with something, your yields go down. Do you get something from the county? Okay. And in that same vein, you actually may end up with reasonable yields and something happens at the county and you get a payment. So you got this, they call it the basis risk between these things that can be happening. The takeaway from this is your strategy. And I'm hearing some rumblings of this first one, and I do not like it at all. This is not thinking clearly about what these policies are doing. I'm hearing folks suggesting they're going to drop their revenue protection coverage level. Let's say they're at an 80, and they're going to drop down to a 70 because they want to lower their premium and maintain what they think is coverage. Okay, so they lower their coverage level on their farm from 80 to 70, and then they go buy SCO on top of that. You are not maintaining coverage. It may look like it on paper, but you are not doing that, because you now have inside of that coverage, you have some of that coming from your farm yields and some coming from the county yields. And Nebraska has large counties, so there can be events in other part of the county that you did not observe, or maybe you observe that can create a difference there. Okay, and that is dangerous, because then come fall, something happens and you got a little payment on your own 70% RP policy, and then you go and that was driven by yield, and then you go and you're like, well, I can't wait to get my SCO one on the county yield, and the county yield turns out to be good and doesn't trigger, and you're sitting there going, what just happened? So this is dangerous. The other side I've heard is some people are at, let's say, 75% revenue protection, and so they just want to add SCO on top of this. Okay, you're wanting to add some more coverage on top of that. That sounds a little more reasonable, but the same points that I just discussed still very, very much matter here. So you need to make sure that you understand what you're buying and the data that's going into those. I'm talking about the yields there on the county level. Is that yield accurately represented in your county? Because if that yield's actually lower than the expected, then you got a gap in there that you're going to self-insure before you get a payment. And in all of this, you're only going to find out how it works when something rare happens. And we don't want to get payments on this. I don't want to see someone get put in a bad position, but it's still going to be rare for any of these things to hit, like we went over on the prices. So we could go through this year and nothing happens. You lower your RP, you buy SCO, and everything works pretty good. You saved a couple bucks in premium, but the bad event never happened. I still don't like it, because you're exposing yourself to potentially bad things that you may not be aware of. So we have to think very slowly through this and think about those distributions of outcomes, and know at the same time that we're talking about rare events. So there's a the chances are that they're not going to happen. But when they do, that money is going to matter a lot to help that farm pay for bills, pay bills. And with that, Austin, I'll open up for questions from you.
Sure thing. I guess I wanted to start with some of the farm programs, I guess that we didn't talk about here specifically, but like price loss coverage, ARC. Talk about those and like why they may not be effective on their own this year, I guess.
Yeah, so I'll just give the big takeaway. I mean, there's a big gap between where those things are at and where prices are at right now, or the expected revenue is. So it's a low chance of those things happening. But you still need to sign up. Of course, to get to the SEO, you have to select the PLC. I've heard this before, like, well, why would I go down and sign up for any of that? They're not going to pay. No, that's not the point. You're staying in the program, you're staying active, and there is a chance that some of those things could pay. So it could be rare. Some of them may be actually impossible, but you're also signing up for future years as well by maintaining that active sign up there at the FSA.
So is there any reason a producer would sign up for ARC over PLC? Because you need to sign up for one of them to do. Well, I
Correct.
think if you sign, there's a lot to it. If you sign up for ARC, you can't do the SEO option because it's
yeah. So let's look up at the upper level and just look down on that. So if you're thinking about do I sign up for SEO or ARC? And I know if I only can get to SEO if I go to the PLC side. Okay, that's fine. They're both county level programs, but the biggest difference is that the SEO and ECO, they go off your planted acreage. Okay, they go off planted acreage, where the ARC goes off base acres. And oftentimes there's a difference in those numbers. We have here in Nebraska, typically those numbers are quite close. I've seen some places where they're very wide, where it was pasture ground or something with no base in it, or very, very little base, I should say. And why would you go sign? And then it's all turned, it's converted into cropland. Why would you ever sign up for ARC? I don't know. You're not thinking through how these programs are triggering. You would immediately, in that case, with low base relative to planted, you'd want to go right to PLC and then get right into SEO if you want to get some extra coverage, because that is covered on planted acres.
Is effective strike price for SEO and ECO the October average price? Yes. Okay.
Yeah, that's right here. Yeah, it's the exact same thing that's done over on the multi-peril side.
Yes.
Exactly. So it will use the same projected price. It will use the same harvest price. The difference is then you go to a county yield versus your farm.
Are there any specific characteristics of an operation that would make it more suited for yield protection or revenue protection, one or the other, or a certain level of protection? Or does it really come more down to personal risk preference and kind of your willingness to pay?
Oh, that's a $1 million question. So let's walk through time. So 40 years ago, there was a very small crop insurance program. You had a very active FSA program at the time. Let's jump up a couple decades. So we're 20 years ago, in the mid 90s, let's say. They're still 30 years ago, but you get the idea. And there's starting to be a crop insurance program evolving, and there's a few choices in that. And on the FSA side, you essentially had a farm bill. You had just whatever you signed up for. And let's fast forward a little more today. Let's go into the 2010 area, a decade ago, or the past 2 decades. And there is a whole bunch of crop insurance contract choices. They're allowing you then to differentiate the contract for what works for you. That's very evident by the fact that they offer you this large menu of contracts. And on the FSA side, they've also done something similar, where at least now there's a couple choices. It's not to the degree, but there are choices in that. So yeah, you got a pile of choices in crop insurance from that menu to select from, but there are typically a few that stand out, but there's reasons to deviate from those. So let's walk through that. My opinion is there needs to be more thought to what insurance right here is doing to you, doing to your exposure, or bad things happen. How bad does your exposure get when bad things happen, and how you can take advantage of this information then to make better financial decisions over the long run for your farm. Okay. You may or may not ever get a payment from crop insurance. You farm 40 years, you may never get that drought or have that really big windstorm on irrigated production or hail. It may never actually happen. That's still okay, because you were strategic with your finances, that if something bad happened, you were still going to survive. And that gives you power to make even better decisions on your farm. Okay. Now in that, if your farm's working capital, let's say, is a little bit on the tight side, you really can't personally afford a big loss to go back to your bank saying, man, I can't pay back everything. Can we roll some of this? So then you should be upping your coverage level to offset some potential for loss, knowing then that you have protection, and then again still make solid financial decisions going through the season. For the revenue protection versus yield protection, that's effectively a hedger's question. However, meaning that if you hedge more, maybe you could hang over on the yield side, but there's still subsidy dollars here, premium subsidies on the revenue protection side. So even with that, I would hang over on that side for a general rule of thumb. But I've seen some pretty sophisticated producers, that really thought deeply about what type of contracts they're buying and why, and they're very aware of their exposure, and they're making a solid farm financial decision in this thing, because this isn't just a reductionist view of crop insurance by itself. We're talking about the whole farm enterprise. We're talking about what type of crops we're going to grow, how it works with our working capital, how it works with the FSA office, how we invest into the future. This whole thing, it fits into everything.
Maybe one last thing here. The way I see it, there's kind of two kind of extreme demographics, I guess, when it comes to people choosing crop insurance. Guys that do the same thing year over year, and maybe some guys that kind of try to pick and choose whether they get crop insurance this year, and based on what they think is going to happen. What would you say to those kind of two groups of people? Maybe some advantages, disadvantages, downfalls to their strategy.
Okay, so we have some that just buy it every year, and then we have some that are opting in or out, or lowering coverage, upping coverage, sort of thing. Is that the general idea?
Yep.
Well, it's the future is unknown. So I can't tell you where, like on this graph here, where we're going to end up come fall. But the chances are definitely in your favor, that prices will end up above, in this case, an SCO price payment, holding yields alone. However, you as an individual have to know what happens to your farm, your finances, if the rare bad event occurs. And we need to think about what's down in those tails down there. I'm talking that $4 corn price, that there's a chance for. What happens to your farm if that occurs? And maybe you have a lot of working capital, and you can use that then to get by. That's totally fine. That strategy may be working completely fine, but I just can't in the recent past, but the last 5 years, 10 years, 20 years, 20 years is just 20 observations in here. There's so many more that can happen that we just have not seen yet. And that's what concerns me, is that, because it can get bad really fast, and it's completely out of our control. And we literally have only to March 15th here to decide our contract.
Sure.
We're talking about that? Yeah. So while we've been talking about just prices here, there is the yield side. And the higher your APH keeps growing, is there's more coverage than you're getting on per acre on your farm. And so that is a wonderful thing to try to keep that thing growing every year, so you can cover more of a potential loss. You'll have a bigger payment then, knowing that, you know, going out over the next 30 years, 20 years, there's a quite high chance that we'll get a drought, at least in one of them, or on the irrigated side, you know, wind and hail. Some places more frequent than others. That something will happen. But in the meantime, as before those things happen, we want that APH to grow, because then at that coverage level, whatever it is, you're going to assure more bushels, and you're giving that risk to someone else, and that is a wonderful thing. So not getting a crop insurance payment and improving your APH is still a win for your future crop insurance coverage.
Well, that's what we got for today. Thank you so much, Cory, for taking time to be with us. It was very informative. I learned a lot myself. I did not realize the volatility I didn't realize the impact that volatility had in how expensive you'd be paying for crop insurance. So that's something I learned today. That's awesome. I hope it was valuable insight for all of you, and as you make your crop insurance decisions in these next few weeks here. For those who still have to meet with your agent, don't be afraid to reach out with questions. Not to completely throw them under the bus, but I'm sure Cory would be happy to speak to a lot of those. Other than that, thanks for tuning in today. If you'd like to see a specific topic covered in this series, like I said, shoot me an email, austinh@nefb.org. And another plug, if you're interested in viewing any of these videos in this Inside Profitability series, you can find them on the Nebraska Farm Bureau website at www.nefb.org. And with that, I think it's a wrap. Thanks again, Cory, and everyone have a great rest of your day.